I'm Alex Oxenham,
I'm Craig O'Neill.
Hilton Capital Management.
I would say the general investment approach of all the Hilton strategies is a lower beta, lower volatility experience for the end investors.
Hilton's investment strategy is predicated on attempting to take less risk than the market with a focus on income. We've been around for 24 years, and all of our strategies have that practice built through them.
What makes Hilton Capital special is we're a boutique advisor. We're all entrepreneurs, very similar to the advisors that we work with and their end customers, who are mostly business owners. We think like they do.
DIVYS is very unique relative to other large cap dividend strategies. If you look at the marketplace of dividend strategies, there's really two paths that they take. One is the high dividend approach, where they're really screening towards companies that have 3 or 4+% yields, and the other approach is a dividend growth approach. And I can't say that either of those are wrong, but we're kind of neither in DIVYS. We do prefer dividend growth over a high absolute dividend, but if you go throughout history, chasing high dividends in and of themselves have created a lot of risk. In 08, 09, there were a lot of problems with those strategies. Also, being solely focused on dividend growth makes you more of a growth fund than it does a core dividend fund. And so we straddle that line.
What makes DIVYs unique relative to other large cap dividend strategies is we're not picking exactly growing names, and we're not picking the high dividend payers. It sits kind of in the middle.
What we're trying to capture is the essence of dividends in large cap companies versus betting on either a high dividend or high dividend growth. The investment landscape over the past 10 years has changed dramatically. Not only are there amazing new technologies, there are new asset classes that investors can take advantage of that didn't exist. DIVYS was made to weather that.
The interesting thing about DIVYs, it was actually a request from a customer if we would develop this strategy for them. After developing and running it for them for several years, we decided this was a viable strategy that we should roll out to all of our customers.
But one of the key attributes that we've always looked for that's actually become more core to our process is the rate of change inflection and the company's fundamentals of the companies we look to invest in. Things like improving margins, improving cash flow, improving earnings. But I think what's become more important is their ability to adapt to these changing economic landscapes. When you invest in a company, you're investing in a management team that you expect to be proactive to take advantage of these economic changes.
It's important for Hilton because, one, it broadened our product base and our offering, and it's in a category that almost all investors should have some exposure to.
Investors are excited about getting yield. It's been about 20 years since they've been able to get a decent yield, and I think we've seen some new dividend announcements from tech companies, and I think that's becoming a real pull from investors. They're demanding that. So I hope for DIVYs that trend continues. Technology has really impacted our investment process in a big way. We have access to more information than ever before. AI and the new LLMs are really augmenting our ability to do quicker due diligence, to uncover things that may have taken hours in a matter of minutes. We're also interested in the companies that help support this, so it's sort of a double-edged approach.
I think where DIVYs fits nicely in an overall allocation as a bulwark in the middle, all investors have some need for income and should have income in their portfolios.
The DIVYs strategy can be very effective in investors' portfolios. As the landscape's changed over the 20 years, what's not out of favor is investing in large companies with earnings growth and a consistent history of paying a dividend. And the S&P 500 as an index has changed dramatically. It's much more concentrated in sectors, concentrated in large cap stocks. Our approach has always been diversified, but really focused on companies that pay dividends, that have a return of capital discipline, that have an emphasis on growth, but doing it in a dynamic and diversified manner. What's never going to go out of style is investors' appetites for companies that can steadily grow, and dividends are a way to screen for those types of companies.